Everyone has an opinion about which generation is winning with money, but opinions are not numbers. Today we are doing what we always do here at the Wealth Metrics. We are going to let the data speak. And what the data says is genuinely surprising. Not in a clickbait way, in a "you probably had this completely backwards" kind of way. We are talking about Millennials, Gen Z, and Gen X. 3 generations, 3 very different relationships with money, and one question that almost nobody answers correctly. Who is actually building wealth faster right now? Not who has the most money total. Not who complains the most online. Who is building it faster, relative to where they are in life? The answer changes everything about how you think about this conversation. So let's get into it. As of the fourth quarter of 2025, according to Federal Reserve data, baby boomers hold 51.2% of all wealth in the United States. That is over $83 trillion sitting with one generation. Gen X, now ages 45 to 60, holds $42.6 trillion. Millennials and Gen Z combined hold $17.1 trillion. About 10.5% of all U.S. wealth. Most people see those numbers and stop there. Older generations are rich, younger generations are broke. End of story. But comparing total wealth across generations is like comparing a marathon runner at mile 24 to one at mile 8 and saying the first one is faster. It is not a fair race at the same point. The only comparison that actually tells you who is winning is this. Is each generation ahead or behind where previous generations were at the exact same age? That is the test. And when you run that test with real Federal Reserve data, the answer surprises almost everyone. Gen X is born between 1965 and 1980. They are 45 to 60 years old right now. And they are the generation that financial media consistently ignores. No viral debates about Gen X habits, no hot takes about Gen X spending. They just sit in the middle, financially speaking, and almost nobody looks closely at why. Here is the thing about Gen X. Their peak earning years collided head-on with 2 of the worst economic crashes in modern American history. The dot-com bust hit in 2000 and 2001. Gen X was in their 20s and early 30s. Just entering their prime career years, building momentum. Then 2008 arrived. Housing collapsed. The stock market lost roughly half its value. And Gen X was now in their late 30s, right in the middle of what should have been their most powerful wealth-building window. The data captures this exactly. The median net worth for Americans aged 35 to 44 fell from $127,000 in 2007 to $58,000 in 2010, a 54% collapse in 3 years. Gen X did not cause that crash. They were just the generation standing directly in its path. Twice. And on top of that, Gen X has been carrying what researchers call the sandwich generation burden. Supporting aging parents on one side, often paying for college-age children on the other, simultaneously. Despite all of that, Gen X currently holds $42.6 trillion in total wealth. And they started investing at around age 28 on average, 3 years ahead of boomers who started at 31. The honest Gen X summary is this. They got hit at exactly the wrong moments by forces they did not cause. Their wealth position today reflects bad timing far more than bad habits. Millennials are born between 1981 and 1996. The oldest are 44 right now. The youngest just turned 29. No generation gets more grief in financial media. Avocado toast, latte spending, bad at money, you have heard all of it. Here is what the data says instead. As of the second quarter of 2024, Millennials had accumulated $15.25 trillion in total wealth. 5 years earlier, that number was $3.93 trillion. A near fourfold increase in 5 years. Millennials' wealth grew 13% in 2024 alone. That is one of the fastest single-year accumulation rates measured for any generation in recent history. But here is the number that really matters. When early millennials were in the 35 to 44 age bracket, their median net worth was $135,000 in inflation-adjusted 2022 dollars. When Gen X was in that exact same bracket back in 2013, their inflation-adjusted median was $60,000. When boomers were in that bracket in 1995, their adjusted median was $101,000. Again, adjusted for inflation. Line them up. Boomers at that stage, $101,000. Gen X at that stage, $60,000. And millennials at that same stage, $135,000. Millennials, at the same age and same life stage, had more wealth than either of the two generations before them. That is the number that breaks every lazy narrative about this generation. But the millennial story has a split inside it that we have to be honest about. The wealthiest 10% of millennial households in 2022 had 140% more wealth than boomer households had at the same age back in 1992. But the bottom 10% of millennials were actually behind their boomer counterparts at the same stage. The millennial wealth picture is not one story. It is two very different stories happening at the same time. What explains that bottom half struggle? Three structural forces. First, student debt. Nationwide student loan balances now exceed $1.83 trillion. College tuition has risen roughly 9 times what it cost in 1989. Millennials carry about 36% of all student loan balances. Second, housing. Between 1990 and 2024, median home prices rose more than 400%. Median household income over the same period rose less than 200%. The price-to-income ratio for homes was 3.1 times in 1981. In 2025, that ratio is 5.2 times. The median home price is now $415,200 against a median household income of roughly $80,000. The median age of a first-time home buyer hit 40 years old in 2025, an all-time record. It was 29 in 1981. That 11-year delay means 11 fewer years of equity buildup. And equity has historically been the biggest wealth driver for middle-class families. Third, consumer debt. Millennials hold about 41% of all consumer debt in the country, almost double the boomer share. And in 2025, for the first time ever, millennials surpassed boomers in average credit card debt at $6,961 versus $6,795. So the millennial picture is this: strong gains at the top, real structural headwinds in the middle, and a housing market that broke in a way it had not broken for any previous generation entering adulthood. The data still shows millennials ahead on an age-adjusted basis. But that headline number hides how unevenly that wealth is distributed. Gen Z is born between 1997 and 2012. The oldest are around 28 or 29 right now. The youngest are still in high school. In total wealth, Gen Z barely registers in the Federal Reserve data. They are just getting started. That is completely expected. But there is one number about Gen Z that changes the entire generational comparison. And it is not about how much they have. It is about when they started. The average age at which Gen Z made their first investment is 19 to 20 years old. Look at that number across generations. Boomers started investing at 31 on average, Gen X at 28, Millennials at 25 or 26, Gen Z at 19 or 20. A 12-year gap between the oldest and youngest generation in this data. And in investing, 12 years is not a minor detail. It is everything. Here is the math. You invest $5,000 at age 20, earning an average of 8% annually. By age 65, that single contribution grows to roughly $160,000. Now the same $5,000 at the same 8% return, but you start at age 32 instead. By 65, you have about $57,000. Same money, same return rate, just a 12-year difference in start date. The outcome is nearly 3 times larger for the person who started at 20. That is the compound advantage Gen Z is quietly building right now. Not through higher income, not through better luck, through time. And that timing advantage shows up in behavior too. A 2026 Motley Fool survey of 2,000 individual investors found that 67% of Gen Z investors already hold AI-related stocks, the highest of any generation. About 56% of Gen Zers between ages 18 and 25 report holding at least one investment. And roughly 1 in 4 Gen Z investors started before they even turned 18. Now, we have to be honest about the risk side of this too. Of Gen Z investors, 55% are primarily invested in cryptocurrency. 19% hold only crypto and nothing else. That is a highly concentrated and volatile position for someone still building their foundational wealth. Gen Z also trades more frequently than older generations. And 1 in 5 Gen Z investors says social media influences their investment decisions. That is a pattern that requires serious self-awareness to manage well. So Gen Z has a structural, time-based advantage that no previous generation has had at this life stage. But some of the behavioral patterns around crypto concentration and social media-driven trading could erode that advantage if they go unchecked. The question now is, when you put all 3 generations side by side and compare them properly, what does the actual scoreboard look like? As of the third quarter of 2025, Federal Reserve distributional financial accounts data shows the combined Millennial and Gen Z cohort has an average wealth of nearly $146,000. That puts them ahead of where Gen X was in their late 30s, and ahead of Boomers around age 37, adjusted for inflation. This is the Federal Reserve's own numbers updated in March 2026. This is not an opinion piece or a generational argument. This is the official data. For the under 35 group specifically, median net worth jumped from $16,000 in 2019 to $39,000 in 2022. The largest 3-year gain for that age group ever recorded. Some of that surge was pandemic-specific. Stimulus money, paused student loan payments, a hot stock market. Real factors that gave a temporary boost. But even when you strip out those temporary contributions, the underlying trajectory for younger Americans is stronger at this life stage than it has ever been for any prior generation. Now here is where it gets even more interesting. Because wealth in America has not just shifted between generations, it has shifted in how it works at all. In the 1990s, working-age households held almost 70% of all U.S. wealth. The wealth curve peaked during your highest earning years. Work hard, earn more, accumulate. In 2025, about 65% of all wealth sits with households over the age of 60. Wealth no longer peaks during working years. It peaks at or after retirement. What that means is that the American wealth model has shifted from earnings-based to investment-based. The biggest returns no longer come from earning more. They come from owning assets for longer periods of time. Boomers bought affordable homes in the 1980s and watched them appreciate for 40 years. They invested in 401ks through the longest bull market in history. Their wealth is mostly not from salaries. It is from owning things that kept going up. This is precisely why Gen Z's early start matters as much as the data says it does. And it is precisely why the window for compound growth is the most valuable thing any investor under 35 has right now. There is one more piece of this story that will significantly change the generational math over the next 20 years. By 2048, an estimated $124 trillion is projected to transfer from baby boomers and the silent generation to younger generations. This is the largest intergenerational movement of assets in American history. Over the next 10 years, Gen X heirs are expected to receive the most in absolute terms. Their boomer parents are entering the transfer window right now. Over the next 20 years, millennials are projected to inherit the most of any generation. But here is the number that most people miss when they hear about this. About 50% of the total transfer is expected to come from just the top 2% of households, roughly 3 million very wealthy families. For most Americans whose parents were middle-class boomers with a 401k and a paid-off house, the inheritance will be real but modest. Typically $50,000 to $150,000, arriving when the recipient is already in their 50s or 60s. That is not nothing. But it is not transformational money if it arrives at 55 when retirement is only 10 years away. The great wealth transfer will mostly benefit families that already have financial stability. It is more likely to widen the gap within younger generations than to close the one between them and boomers. So after all of that, what do you actually do with this information? Lesson 1 is about time. Gen Z is proving what compound math has always said. The most powerful wealth variable is not income. It is not even your rate of return. It is when you start. Starting at 20 versus starting at 32 with the same money and the same return produces nearly 3 times the outcome by retirement. That is not motivation. That is arithmetic. If you have not started yet, the best time was yesterday. The second best time is today. That is not a cliché. In compound math, every year of delay has a real dollar cost attached to it. Lesson 2 is about the model. Wealth in America now rewards asset ownership over time more than it rewards earning. Index funds in a tax-advantaged account, started early and held long, is not a passive strategy. It is the core strategy the data supports. Real estate still works, even at today's prices, if your entry point is sustainable for your situation. The math still favors long holding periods. The issue is the entry cost, not the model itself. Lesson 3 is about what you can and cannot control. Most of the wealth gap between generations is structural, not behavioral. You cannot control when you were born or what economic conditions greeted you. What you can control is whether you own assets, whether you start now, whether you stay invested through the volatility that every generation faces, and whether you manage debt aggressively instead of letting it compound against you. Every generation that stayed invested through the rough patches came out ahead. Every generation that bailed during a crash gave up their recovery gains to someone who did not. The final lesson is about the narrative. Stop using total wealth as the scoreboard for this generational comparison. It is the wrong metric. It always will be. The real scoreboard is age-adjusted net worth. And on that scoreboard, younger Americans are not losing. They are ahead of any previous generation at the same life stage. The system has structural problems. Housing is harder. Student debt is real. Wealth concentration is real. None of that is false. But within those constraints, the data says younger generations are doing better than the cultural narrative gives them credit for. Here is the number I want you to remember from everything we just covered. $146,000. That is the average wealth of the combined Millennial and Gen Z cohort as of the third quarter of 2025, ahead of Boomers and Gen X at the same age. Despite recessions, student debt, and a housing market that broke in ways it had not broken before, Gen Z is setting up a compounding advantage through early investing that the math says will be worth hundreds of thousands of dollars over a lifetime. That is not hype. That is arithmetic. And millennials, the generation that the internet has spent a decade calling financially irresponsible, are ahead of every previous generation on an age-adjusted wealth basis. The surprising truth is not that younger generations are behind. The surprising truth is that age for age, they are actually ahead. What they do not have yet is time. And time is the one thing you cannot shortcut. Real numbers. No noise. That is what we do here at the Wealth Metrics. If this changed how you think about generational wealth, subscribe so you do not miss the next one. See you in the next video.